Hey everybody, this is Dr. Tom Carr, aka Dr. Stoxx of drstoxx.com. That's drstoxx.com. We've been in business every market day since October of 2002, publishing the Trend Trade Letter, our award-winning flagship premium letter where we trade marquee type stocks, the market leading stocks. We only go long in that letter. ETF letter is a good letter for those who are looking to go both long and short different market sectors at the right time. We use 2x and 3x bull and bear versions of major indexes and sectors, and even some of the single stock funds now. And the Momentum Letter, my most profitable service, but it is kind of a wild ride at times. And then we have the two live rooms. I'm coming to you today from the live options room, which is our newest of the two rooms. Only do options, and I would have to say 95% of the time it's just long calls and puts. You can do that in an IRA or anything else. And the flagship service of the live trading room is the live trading room, which I started back in 2019. We've been making profits just about every month. Every year been profitable, and we just hit a new all-time high yesterday, and we're just sailing along with the market not doing a whole lot. So let's take a look at the market, guys, because I want to, first of all, I want to invite you, if you're not a member of ours, to go over to the subscribe menu, scroll down to either a stock pick advisory for one of the letters I just mentioned, live trading room, and then you can add on the options room at 40% discount. Okay, charts. I have to do this quickly. I'm sorry. I got a little bit of a late start, and the market's kind of, it's not being bad today. It's just being very tight and choppy. No direction today. And we've got a 3-day weekend coming up with Martin Luther King on Monday, and I want to make sure that we're well positioned to take advantage of what likely will be a bullish move after the break. So here's what's going on in the market. We are losing, I emphasize that, losing momentum in the S&P 500. The same is true for the NASDAQ, and in fact, it's even more true for the NASDAQ. So the NASDAQ hit an all-time high way back here in October, and it's been underneath that ever since. The S&P 500 hit a new all-time just a few days ago. But these are like really shallow breakouts, and then they're not holding. We're falling back down into the old range, and you can see that the pivot lows are getting a little lower. The pivot highs are getting a little lower. It's not a robust market as it was back in this age. Here off of the tariff crash lows in April, that was one of the best buying opportunities we've seen in several years. At the end of the 2023 bear market, we went heavy long. At the end of the tariff crash, we went heavy long. At the end of the COVID crash, we went heavy long. And those are the three periods that we've made our most money in the least amount of time. And of course, that's what you got to do, right? When there's blood in the streets and there are some signs that, of course, things have come to a bottom. Much easier to determine the bottom than the top. Now, let's get back to the top where we're at. This is not an all-time high. This is not the beginning of a bear market. It is not the end of the bull market. No, the market's just ready for a little bit of a breather. So it is discounting some important things. Tariffs, there's still some uncertainty there. We've had some geopolitical risk. There are some regulations that keep getting thrown out on the table and then pulled back again that could put a crimp in the chips market, for example. There's still the concern about AI data spending, CapEx spending, not crimping margins and not showing much profit potential, and a whole host of other things that, of course, the market's always worried about something. So it just needs to have some time to digest all that. Valuations have gotten historically very high. So historically, the S&P 500 trades at about a 20 trailing PE ratio for the average of all the stocks in the index, and right now it's more like a 30. And that's 50% higher than the average. So it needs to cool off. Now, part of that, of course, is that we're in a new kind of an economy right now. We're moving away from manufacturing, moving back towards services, technology, new technology coming along, and so people are the amount of the prices are going up for stocks because commodities and services are going up, goods are going up. But also, the earnings have been stifled a little bit in terms of percentages of growth because everybody's having to invest in all of this new infrastructure and all the new energy and all, and Trump is coming out. This is one of the regulations. He's coming out forcing big tech companies to pay for their own energy services. He wants to drive energy prices down, which is good for you and me, but it's not going to be good for those big companies. That's just another cost that will eat into their earnings. So, okay, all that said, the market's always got a bunch of stuff it's worried about, but right now it just happens to be a pretty big set. There's still some uncertainty about where all that is going. So at the very best, we probably will have 6, 8, 10 weeks of fairly tight and choppy range-bound action. And I think we pretty much already see the tops of the range, right? What we've got right now, if we can kind of stretch this out, maybe we get a little bit more upside in the next couple of weeks, but then we get out into the end of the first quarter right there. That should probably mark the top of the range. And then the worst case scenario would be a pullback all the way below 6,600, 6,550 or so. I kind of don't think it's going to get down that low unless there's something unexpected that comes along. If earnings come out and they're all horrible, we enter into World War III. The president is assassinated, something like that. That could certainly send us down even lower than that price. But I don't think we're going to get that far. I think rather more likely we're going to see something like this former all-time high and some of those pivot lows coming into play right around here at 67.80 or so. Then I can just see us bouncing back and forth between those two levels over the next 2.5 months. Now, I do think that if we do that, if we hold within that range, that we should see something a little bit better in the summer. If we, however, stay fairly elevated and the market doesn't have a chance to discount some of these concerns and the concerns don't go away, then I think, and this was my original map, I think we're probably in for more of a hot summer in terms of the market really coming in a bit more. And then we probably will see these lows coming into play. But I really don't think, and frankly, we don't care about that map at all because we trade one day at a time. We let the market tell us what it's going to do. And right now it's telling us that it's just not going anywhere. It's not going up and it's not going down. And every little dip can be bought and every little rip should probably, you should take some profits off the table. But the key for us, and it always has been the key for us, we want to find out where is the real money going? What are the sectors and the stocks and the leaders that are showing strong trending action, strong price momentum, strong volume inflows, right? Strong accumulation and call volume. Where are those guys? We found a number of them, right? We've been in some biotechs. We've been in gold, silver, mining. All of those have done really, really well. I happen to think banks are probably the next place that will start to do some outperformance and probably will break up above their trading range. And biotechs also, I think, are in that camp. And I do think the metals, once they cool off, the miners, once they cool off a little bit, maybe flatten out a little bit, they're going to have another nice leg higher and they will outperform once again. They'll probably outperform all the way through the summer. I think so, at least until May. Okay, so that's kind of my map, right? So right now, don't have a lot of expectation for the overall market doing really well. In fact, I would kind of stay away from buying SPY calls, for example, or TQQQ, the 3X bullish version of QQQ. I just don't think, except for short little bursts, I don't think that those guys are the best place to put your money. But if you drill down into the NASDAQ 100, like we did with the storage sector, right? We're in STX in the live trading room. We're in Micron and Marvel in we're in Micron in the live options room. And we were talking about Marvel back in the other room and AMAT as well. And I have some WDC, some Western Digital. So the storage sector has been doing really well, just rip roaring, straight up kind of stuff. It's cooled off a little bit. Now I think it's starting to build another leg higher. So we find places like that are set to outperform the market and will be just fine, which is what we try to do anyway, whatever the market's doing, whether it's straight up or straight down. If it does, however, start to get weak, then yeah, we're going to have to get a little bit more of a bearish posture. very easily done. And in that case, I think we probably can put on something like SPXS or some SPY puts, SQQQ, TZA, right? Let's take a look at the Russell 2000. This is the one, this is what I mean, right? This one has been outperforming. It's banging up on all-time highs, volume coming in like crazy, and it's just been doing great. Now, we were in the Russell in the live trading room. We were using the Micro E-mini to trade that. We ended up with a very nice gain. I just got us out too soon, which I typically do. My worst trait as a trader is exiting my winning positions too early. I get rid of the losers fast, and that's probably the best trait you can have as a trader. And I have a very good way of spotting the market's next leaders and the breakouts and the consolidations before they start moving like crazy. Pretty good system, right? Is a system. I just punch a bunch of buttons and I look at some software, and I have like a process, right? A methodological process that will highlight the top 3, 4, 5 stocks that meet all the criteria I'm looking for. But my worst, and so we get into these winners and they do really well. My worst trait as a trader is taking that 30% profit off the table, putting it in the bank instead of waiting for the 50% profit that came a couple of days later, right? Anyway, that's just what it is. I do think that Bitcoin and Ether are, well, I tell you what, Ether is kind of like, I'm not sure about Ether. Bitcoin 95 is the key number. I said yesterday, 3,300 for Ether needs to be a must-hold level because that's the range highs. If you put a line over those range highs, it's right around 3,300. And if it falls below that, it's probably going to keep falling. The same is true for Bitcoin with 95. And we're right at 95. That black line there is the line I'm thinking about. I really did think Bitcoin was going to go all the way down to 75. I said this back on that red bar right there, early November, and it got to 80. So it didn't quite get there. And then it started to do some bullish things, right? It broke out of the RTL. It broke above the 95. And yesterday and today, so far, it's holding that level. But as I said before, if it gets below 95 and closes there, it's probably going to trip down a bit lower. So it's still not a safe zone as far as I'm concerned, unless you're thinking of long-term investment. But it's not a short anymore. It used to be. And we were short both Bitcoin and Ether. We made a profit in Ether. We hit a raised stop in our Bitcoin put position. Okay, yeah, gold and silver, not going to talk about right now. I would just stay out of them for a few days, but we'll take it one day at a time, and I'll let everybody in the room know when we're getting back in, because I do want to get back in. Silver calls, GLD calls, GDX calls, SILJ calls. Those are all good places to be. We also just got into a platinum call position today in the options room. And copper, you shouldn't keep copper or aluminum or steel off your list either, because all those guys are likely to do outperform over the next few weeks. Okay, that's all I wanted to do with Stoxx. So let's go over to, first of all, we'll look at black box Stoxx. This is the software I use to monitor call flow. And I use a filter here. I always set this at 100,000. I took it off for a little bit ago to see if there was any volume on Cypher. 100,000 minimum order, 100 contract minimum order, at or above the ask. I've got calls and puts in here, and I've got both stocks and ETFs. At or above the ask means I'm not going to look at any put selling. I'm not going to look at the lower end of a credit spread. I'm only looking at people that are buying calls or buying puts, right? These are directional plays. And I don't have this multi-leg toggled on. If you have that on, you're going to also see buying calls, buying puts, but they're part of a spread. And I don't really want to look at those either. I just want the guys that have strong conviction. They're going just for a directional trade. There are a couple of things that you can do as you're watching these new orders come through, and you're going to see 10, 15 orders come through every minute. Maybe not so many. When the volume goes up, the market's hopping, you'll see a lot more. When the volume's really quiet and the market's not moving now, you're going to see a lot less flow. but you want to kind of look at the, just look at the colors. Green calls more than red puts, bullish sign. These yellow colored orders here are very unusual, right? In terms of the volume on that particular contract, way above open interest, for example. So pay attention to those. Someone's very interested in Datadog. Let's see if we click on this. We'll get all the trades in Datadog today, and you can see it's kind of a mix, right? Two big puts, two big calls. The call is interesting. Which is the biggest one? The biggest one is a put. Okay, so if you're bullish on Datadog, this is not that encouraging, but it's not a deal killer either. But here's what, let me say I'm interested in Nvidia calls, which we bought yesterday in the options room. So I type in Nvidia, and I'm just going to show you this little trick, but it's not the primary thing I use to determine our strike and our date of expiration. And everybody's always asking, how do you know? Because you've got a gazillion different options. You can do it 1 week out, maybe even a few days out, and with a SPY and QQQ, you can do it every day. In fact, you can trade these what they call ODTE options, which are 1 day to expiration, 0 days to expiration. What it means it expires today, and those are fun to trade, but that's only for the quick-witted day traders that have strong stomachs. I don't recommend it if you're not a very experienced trader. And I do a lot of day trading. I have done a lot of day trading. I'm pretty good at it, I have to say. I've got a whole course on it. If you're interested in learning my method for day trading, it's on my website. But it just doesn't fit very well with my risk tolerance profile. So I much prefer to put on a trade and just put on the stop and put it on the target and let it run. And then I adjust it, every couple of times a day, I adjust the stops. All right, so NVIDIA. Now, what I want to do is look for a pattern. Is there a whole bunch of orders or some really big orders going through at the same strike price at the same expiration? Now, let's just go down. We've got a whole lot of different strike prices here. I'll tell you what, let's rule out those that are going to expire on today, right? 116. We don't want to know about those. Here's a February. Here's a February 27th, which is a weekly expiration. Here's a March. I'd be more interested with those that have some time, right? March 20th. Here's one all the way out to September. That's a call play, March 20th. So this March 20th seems like it's a pretty popular expiration. So I'm going to put that in my brain, right? March 20th is a place where a lot of the big traders are going for their expiration date. Okay, well, that gives me a pretty good piece of information. And I can even click on these. I'll click on the 320. And I can see they're all calls at the 200 strike, and they're all at the same expiration. And this is, is a bit out of the money, right? It's got to get up to 200 before they even start seeing profits. And they're paying $8.50, $850 for the privilege of holding those calls to see that happen by March, 200 by March. And then it's got to get up above 208.50 for them to even break even. So these guys are pretty bullish, right? This is a pretty bullish take. And these aren't huge. These aren't $1 million orders, but they're sizable enough to know, and it's probably the same guy, sizable enough to know, at least the 500 and the 500 are probably the same guy, to know that this guy's, doing some damage here on this particular contract. We click on this little icon over there in the corner, we're going to get the historical information, and this looks good, right? Here's what you want to see on historical information. First of all, you want to see these green. You want to see all these green over here under open interest. Is open interest going up for this contract, or is it going down? Well, if it's red, it's gone down, which means people are selling those contracts, getting out of them. The open interest is going down. But if we see them green, especially big 4-digit improvements in open interest on this particular contract, that's a very good sign, and it's going up every day, right? 37,000, that was a huge day, right? Huge, huge. Okay, so it's gone from, down here at 60,000 on up to 130,000 in just a couple of weeks. That's also a good. So I'm putting that into my brain, right? 200 strike, March 20th, looks really good. Everything's lining up. for that particular contract, that particular strike. Now, I could have chosen probably a couple of others that have similar sorts of patterns like this. We could go out to June, we could go into February and come down and strike, go up and strike. You're probably going to see some things like this, but this is a confirmation that at the very least, March 200 is a good place to start looking. Now, more importantly to me, let's go to the NVIDIA chart since we're talking about NVIDIA, is what's going on. Let me get rid of my little map here. It is actually playing out, but I don't like what's going on today. A lot of gap and craps today. They gapped up and they come back down, and so most things are kind of bouncing back up again here into the close, but we'll have to see. There's just not a lot of movement today. So let's get rid of the drawings. Here's NVIDIA. So currently it's at 187.83. 200 is up here. Let's mark these, right? Here's the 200 strike that we were talking about. And where is the March 20th expiration is right there. Okay, so these traders are talking about a movement of NVIDIA that will get up above that 200 and more, because they want to cover their cost basis, their premium. Now, of course, that 850 is because it's out of the money. It's pure time value. There's no intrinsic value. Once it gets up above 200, you start building up intrinsic value. Typically, once you get hit the strike price, you're at the money. That's a 0.5 delta, which means that for every dollar that the NVIDIA shares go up, the option price goes up 50 cents. So, and that will increase. So when you get up to like 205, it's not a 50 delta, it's more like a 55 or 60 delta. So you start, as you get higher and higher, you start building up more and more at a faster rate intrinsic value. But also at the same time, the time value is coming off. So this is where options can be kind of a challenge, right? You've got to weigh against the loss of time value and the gain in intrinsic value, but you got to give yourself a chance of getting that intrinsic value, and they only are going to have that chance if it goes up. All right, so here's a couple of things you can do besides what I just did, right? If you've already got in your mind a strike price and an expiration date, put those on the chart and see if you think the chart looks like it could get up there, right? You want to get up at least, I would say 208. So actually, let's just move this up, right? Let's move up. Not where strike price we know is 200, but if we move this up to where if it includes the premium, that's really the target. Can we get there by the expiration? So frankly, I have a little doubt that, well, this one's going to get there, but maybe these guys only need it to go up a couple of, maybe $4 or $5, and then it's not losing much time value because it's still far away from expiration. So then they sell it. They make their 30%, they make their 20% or 15%, and they're out and they move on to the next trade. That's possibly what they're doing. But here's one thing you can do. So first of all, note the LRC. These are the pink and blue bands back here. There's a linear regression channel. I have it set at 1.5 and 2.0 standard deviation. Default is 2.0 standard deviation. I would just leave it at that. That means that over the last 100 days, that's default also, the NVIDIA is in an uptrend. It's not a strong uptrend, but it is an uptrend. You can see that because the left edge of it is lower than the right edge, right? We've got an upside angle. And it's right at the midline, which is kind of convenient. So what you want to do is you take an arrow and you start back here at the beginning on that midline, and you roll it out to the expiration. And according to the current trend, determined by the linear regression channel, standard deviation 2.0 up and down, on average, we should be at a 191, just based on the angle of the trend so far over the last 100 days. Now, it could totally explode, right? We don't know. It happens. Or it could get, a nice little pop right here that doesn't last, but at least on that pop, you get your upside intrinsic value skyrocketing, and then you can get out with a nice profit on your calls. But just from an odds perspective, holding it to expiration, we're not going to get there. We're really not going to get there. We're not going to get up to 208. This is right here at 192. Okay, so that's not, that's not the best. So if I were doing this and I hadn't looked at the common flow of the calls, I would be not going at 200. I would be going with something more like a 195, or even a 190. I would go. Is it in the money? No, it's 188 right now. So something like a 190, just below, pretty close to at the money. Maybe there's a 187.50. I don't know Nvidia, whether it has dollar increments or 250 or five. They all vary, and it varies by month too. But something like a 190, or even in the money at 185, if that's possible, or 187.50 would be the preferred one that I would get. Why? Because right now the trend is not showing me that it's going to have a whole lot of upside. It's trending higher, but it's a very slow trend. So unless I'm confident that Nvidia is going to really pop, I personally think it will over the next couple of weeks, because it's just been very tight, right? It's a squeeze play. It's just been very tight, uncharacteristically for this. We had the down movement. We had an up movement before that. I think the next leg is going to be an upside pop. And so, it could get up here maybe to 204, 205. And if it does that, we have Nvidia calls in the options room. We'll be out. We're going to sell them and take our profits and go. Okay, so that's one thing though you can do if you're kind of thinking, what's the right strike price? Well, take a look at the angle of the trend. Now, another thing you can do if you're thinking a lot of like a shorter term play is that you take that same arrow and you run a line from the most recent pivot low through the current price, and then you just extend that angle out to the expiration. Okay, now that's a much more optimistic view, but this is only looking at the short-term trend. So this is what the stock has done in the last month, right? 3.5, 4 weeks. What it's done in the last month is a pretty good foretaste of what it's likely to do in the next month, okay? So the fact that I only have 1 month of data that I'm using to determine the angle of this trend means that I'm not going to go all the way out to March for my expiration. I'm going to pull this out, and I'm just going to go out to the next month. It took a month to get from 170 to 190. Oh, come on. It took a month to get from 170 to 190. And now if I project this out for another month, somewhere about there, middle of February, and that puts me up to 209. Same angle, same time frame, 209. That would be the ideal, right? And of course, it is not going to do the ideal. But what I would be looking for then is I'm going to move my expiration date 1 month sooner, because I'm just playing now the short-term trend, not the long-term trend, the short-term trend. I'm going to move it sooner to February. And I don't want to get a strike way up here at 209, 210. I want something a little closer to current price. I'm going to pay more premium for it, but at the same time, I have a better opportunity, better chance, higher probability of then taking ultimate profits. So I'm going to look for something around 190, and maybe I'm paying, I don't know, 10 bucks, 15 bucks, 12 bucks for that. So if let's say it's a $10 call, let me just tell you exactly what it is. I know we don't have much time for this. We're in the Nvidia March 20 calls. Here I am talking about how they're not going to make much money, but let's just assume. And as I said, I do think it's going to have a good pop. Let's assume that we are playing the short-term trend, but we're giving ourselves a little more time in case that short-term trend takes its time in manifesting itself. Let's see what Nvidia gives us on the February calls. February 20. I'll pull this down for you. If it will come, it's not coming. It's not moving. Well, anyway, my screen just kind of froze up there. So February 20th, the 190 calls are going not bad, 750 bucks. Okay, so it needs to get to 197.50 by expiration for me to break even. 197.50, let's pull this down right about there. And I really think it's going to be, if it gets the pop that I think it's going to get, and it should in the next, after the weekend, start to get the pop after the weekend, it doesn't have to go very far for me to start making some nice bank. The delta value in the 190 calls for February is right at 0.50. That is the at the money strike. So the delta value on the calls we're in, which is March 20th, 200, is 0.40. So the closer we get up to 200, I think it's going to get there middle of next month. The closer we get up to 200, the higher that value will go. But it has to get to 200 to get from 40 to 50, all right? Because that's always the at the money delta value. Okay. And look, I'm looking at the implied volatility percentage for the calls that we're in for Nvidia. It's only 42%. 42%. When you see a really volatile stock going up and down, it could be several 100%. That's good for people that are selling premium, and it tends to be a good sign for people that are already in calls, because that means the value of those premium, the value of the premium is going up. I mean, it's really skyrocketing. Right now, Nvidia is really low. 42% for a big tech stock is pretty low. And now, why? Because it's been very quiet. It hasn't been moving, right? Two weeks of going really nowhere. Tight range, a little bit up, a little bit down. Nvidia doesn't do that for very long. That's one of the reasons why I think we're going to return to trend, and we could see a good 15% pop in the shares, and that would mean a 60-70% increase in our value of calls. Okay, so those are some tricks, right? You look at the trend, whether you're looking at the longer term trend, and in that case I would use the LRC itself at the midline, or whether you're looking at the short term trend, again, pivot low through current price, project it forward out, and kind of figure out how, given that, if it proceeds in that same direction, how long is it going to take to get to the price I would like to see it at? And probably the best thing you can do, and the thing I learned early on as a trader of options, is you give yourself an extra month. If I think it's going to take 2 months, go out 3 months. If I think it's going to take 6 months, go out 7 or 8, 9 months. Give yourself some extra time, because a lot of things happen along the way, and you don't want to be losing time value in a stock that's actually even going up, and that happens. Right? If you're in a stock in the last couple of weeks and it's going up very slowly but quietly, you're losing value, you're losing money, even though you would have gained on the shares. So give yourself a little bit of extra time. Now, as a good rule of thumb, here's a good rule of thumb. Let me see if I can bring this down. I wish I could. I can't. I don't know why. Anyway, two rules of thumb: strike price 3 months out, expiration value, expiration date 3 months out, as an average, as a minimum, and at least expiration, and the strike price should be the 50 delta value, as close to the 50 as possible. I have a guy that he was one of my clients many years ago, and went on to make a very good living trading options. And he only trades one strategy, and that is the debit spread. And so what he does the same thing every time. He only does this on the big indexes, so it's SPY and QQQ and IWM. He gives himself the 3 months of time. He goes along the 50 delta, and then he goes short at a higher strike at the 20 delta, 50-20, 50-20 every time. And it's just his way of mitigating risk. Of course, you're capping your gains as well, but he likes those delta values. 50 is usually where you start to get some really nice accumulation of premium, and 20 is far enough away from current price to not erase your gains as the thing is moving higher. So 50-20, if you like credit spreads, that would be my recommendation. But again, 3 months out. 3 months out, 50 delta value for your primary strike, you should be okay. All right. God bless everybody. We'll see you back in the room in just a little bit. Bye for now.